Welcome to the Tax Beat by Cherry Beckert podcast. And today's discussion centers on the tax provisions of the American Rescue Plan Act, also called ARPA. But first, let's introduce my colleagues who will be joining me today. Sarah.
Hi, I'm Sarah McGregor. I'm a tax director in our federal tax services. I sit in Greenville, South Carolina, where it is beautiful, sunshiny day and 70 degrees. You want to be here with me.
Marty.
This is Marty Kierman. I'm a principal in our strategic tax advisory practice, and I am based out of our Tyson's office.
What's the weather, Marty?
The weather is excellent today. I'm actually working out of Brooklyn, New York today, so it's beautiful up here in New York today.
Kathy.
Hi, my name is Kathy Stanton, and I lead the state and local tax practice for the firm. And I am sitting in the Washington, D.C. area, and it's about 64 degrees and sunny, which is a welcome change.
And my name is Brooks Nelson, and I am sitting in downtown Richmond, Virginia. It's also been a beautiful sunny spring day. It's about 65 degrees here as well. All right, so before we dive into ARPA, I thought we'd talk about the other big related news item that just came out last Thursday. The IRS extended the individual income tax return filing and payment due date from April 15th to May 17th. And this is directly or at least indirectly related to ARPA as well. So Sarah, why is this related to ARPA, and why do you think the IRS took this action?
Well, the IRS was certainly getting a lot of pressure from trade associations like the AICPA and from small business and from congressional representatives asking them to move this due date out, giving folks more time. It's related to ARPA in one respect in that there was a provision affecting 2020 returns, allowing a portion of unemployment benefits that individuals received in 2020 to be exempt from taxation. And a number of returns have already been filed that need corrected there. And this also allows for individuals to take advantage of this situation and exclude that income from their returns.
Right, and there were also a bunch of CPAs who were asking for some of this relief as well, at least, particularly smaller CPAs and who may not have some of the same technology that maybe some of the larger firms have as well. So, Sarah, what did this extension specifically cover, and specifically, or more importantly, specifically not cover?
It did not cover the broad spectrum of tax returns that are actually due at April 15th. It really was limited to a very narrow postponement for individual tax returns for 2020. So those individuals who have tax returns due at April 15th will now be able to file those tax returns at May 17 and also postpone their final 2020 tax payments that may be due until May 17. One of the important areas for individuals that it did not address was their first quarter estimated tax payments that are due for 2021. That is still due. Those payments are still due at April 15th, and that sets up a real conundrum for a lot of us in the tax professional group that we've got to really go ahead and work on those 2020 returns for individuals so we can figure out how much to have them, those taxpayers make their first quarter estimated tax payment. It also did not extend business returns, trust returns, and any estimated tax payments for those taxpayers as well. So pretty much it was a very narrow extension. I would expect the IRS may wind up providing some additional expansion of that postponement on the deadline to other areas, including maybe individual estimated tax payments, but we'll just have to see.
Right. It certainly added a lot of confusion and chaos to a world that's already rather chaotic as it is. So, and speaking of confusing, how are extensions going to work for our 1040 clients?
Well, they will have an opportunity to file those extensions electronically or by paper, though the IRS has not shown an ability to actually process a lot of paper returns in a timely manner. So certainly filing those would be by electronic means would be important. But I know, Kathy, it's a big problem for state returns too with this last minute change.
Yeah, you gotta love it. It feels like deja vu from last year when all the returns were extended. So from a state perspective, many states are coming out to extend the state return filing as well, because if you don't have your federal return done, you can't do your state tax return. So I think as of this morning, it was about 27 states had issued guidance that they will also allow an extension to May 17th.
So Brooks, what are you telling your clients about the April 15, May 17 filing? Are you telling them they should wait?
No. I mean, as we just already talked about, we've got the, kind of the first quarter estimate conundrum, as you called it. And, there's a lot of concern that if you wait till May 17th to make an extension, and then you end up needing to pay in a first quarter, that you're going to be late. And as it stands now, those estimates would certainly be subject to penalties under the current ruling or current guidance. But beyond that, if you got a refund coming, you want to file now, take advantage of getting your cash back as soon as possible. You want that certainty, cash planning. I mean, there are all sorts of reasons that you want to go ahead and get it done now. So I think the best advice is go ahead, prepare, file as soon as possible. If you don't owe money until May 17th, then take advantage and pay on May 17th. So that's perfectly acceptable under this guidance, right? File now, pay on May 17th when you have to. So I think that's at this point in time the best advice that we got going. All right, so now let's flip over to the main topic of this podcast, the American Rescue Plan Act, ARPA. President Biden signed that into law on March 11th. ARPA is the latest in the series of legislation related to COVID, economic relief, and stimulus packages. Almost for sure, this will not be the last one. There will be more coming. But today we're going to focus on this one, ARPA. And just to be clear, we are limiting our discussion primarily to the tax provisions. ARPA contained all sorts of stimulus and other type of provisions, as have the prior CARES Acts, which are not specific to tax. But so this is a tax podcast, so we will try to center on that piece of it. So Sarah, let's just start and talk about some of the main tax provisions of ARPA affecting individual taxation.
Right. Well, we can't talk about ARPA without first talking about the next round of stimmies, or the recovery rebate payments, or economic impact payments, or stimulus payments, whatever you want to call them.
Right.
This time around, it's $1,400 per taxpayer for a couple filing together. It could be as much as $2,800, and then $1,400 for each dependent. And this round of payments is different than the first two that happened in 2020, with how it's defining a dependent. Pretty much anyone that you can claim as a dependent on your return is eligible for this $1,400 payment. That includes both children and non-children dependents, so parents or others, grown children in college, or those that wouldn't be in the traditional child role that was allowed for these payments on the prior two. The other thing that's interesting on this set of payments for recovery rebate payments is the phase-out range has narrowed. Originally, the first set of payments applies starting at $75,000 for individuals and $150,000 for joint filers, but it phases out very quickly. So when an individual reaches $80,000 of income, they're no longer eligible for the stimulus payment. And for a married couple, when it gets to $160,000, they've now phased out. The stimulus is based on either your most recently filed tax return, which could be 2019 or 2020. So Brooks, another reason someone may not want to file their 2020 return right now is if that income for 2020 is well above this phase-out range, but 2019's isn't, they will want to stick with their 19 return until they get their stimulus payment.
Is this one going to work the same way as the last rounds, that if you happen to get more than you otherwise would be entitled to, you still get to keep it?
That is correct. It's you will not have to pay back or a clawback provision for anything that is paid to you that you are not entitled to when you file your 2021 return. So the final tallying here, if you don't collect it this year during the year, you may be eligible when you file your actual 2021 return. Another important element we spoke to earlier has to do with the unemployment compensation. The stimulus bill, ARPA, did extend additional $300 on top of the regular unemployment benefits that individuals receive up to September 1. But a portion of those unemployment compensation benefits received in 2020 are going to be exempt from tax, up to $10,200. Now, this is going to apply to pretty much most taxpayers until they reach that $150,000 threshold, and then beyond that, they will not be able to claim this exemption from their income. The IRS did say for those taxpayers that have already filed their 2020 returns and failed to take this exemption because it didn't exist at the time they filed their return, the IRS will recalculate those returns and are expected to send out refund checks to those individuals who've already filed. So it's not necessary to go in and file an amended return right away. Two other areas that were pretty important is the increase to the child independent credit, the child tax credit, excuse me. This new change applies only to 2021, and it expands the credit from $2,000 per child to $3,000 per child and up to $3,600 for children under age 6. The ARPA also expanded this credit to include 17-year-olds who have not been eligible for this credit in the past. And so it really is going to help out and follow along some of President Biden's campaign proposals to help out families and provide more to them. And the interesting thing about this is there is a two-step phase out for that. One set of rules for the increase that's happening, and then the original phase out for the original portion. But the IRS is also directed to pay out half of the anticipated 2021 child credit beginning July 1. So for a family with 3 children who would be eligible for the $9,000 of child tax credit, they would be eligible to receive half of that, or $4,500, paid out to them over the period from July 1 to December 31 of this year. So another opportunity to put cash in the hands of individuals who need it to help with their families. The IRS is also directed to create an online portal to help figure out if you had a child in 2020 or 2021, you could go in and add that child so you could start getting payments now, or if you had children leave home or get past 18 or something else change in who is eligible for that credit, this portal is supposed to be able to help with that. The last area that help business families with children is the child and dependent care expense. That also has been expanded and increased and also made fully refundable. So we'll see more of that as 2021 returns are filed. But the other element for those individuals who are participating in their employer's COBRA health coverage plan, that is, they were terminated or involuntarily, or they had enough reduction in hours that they are eligible to participate in their employer's COBRA health coverage plan and are having to pay those premiums. ARPA puts in a sort of a premium holiday, if you will. And from April 1 until September 30, the individuals do not have to pay those premiums. And we'll talk in a few minutes about what happens to the businesses who are supposed to be getting those premiums from those individuals to help pay for that health coverage.
Is that about all for the individuals?
I think so. That's all that's applicable right now. There are a few things in the future which we can talk about later.
Yeah. Well, I think we're all fortunate to have tax software because there's a lot of tricky rules and calculations to be made with all that stuff. All right. All right. So let's switch over to the business side. So let's talk about the implications from business taxpayers from ARPA.
All right. Well, let's start with that COBRA coverage. For those businesses and employers that are having to still pay to the insurance companies or pay for health care for those former employees who are participating in their COBRA coverage plan, suddenly those premiums are going to get cut off, and they're not going to have that cash flow that they could then send on to their healthcare provider or insurer. So the IRS or the ARPA has provided a mechanism to again use the payroll taxes as a way to refund to the employers the cost of that coverage that they're having to foot. So again, this is just a special little 6-month event to provide health coverage to former employees and provide funding to employers to help make that available. Again, using a refund mechanism through the employment tax system. The ARPA provided some additional funding for restaurant revitalization grants and some other special industries, but ARPA, for our purposes, talked about how those are treated for tax purposes. And basically, it's going to be like the PPP loan forgiveness program. The income is not going to be taxable and will be treated as tax-exempt income, but all of the expenses, all of the expenditures that have happened because of this, if they would be a deduction, and if the income had been taxable, they still get to be a deduction under ARPA.
And we're I was going to say, and we're very pleased they went ahead and clarified that up front this time around instead of waiting for all the confusion for coming back a couple months later and finally telling us what to do.
Right. They saved the confusion for other areas of this tax law, that's for sure.
Of course.
Yeah. And there were a couple of other individual provisions that are sort of revenue raisers that dropped in, as well as some help to define benefit plans, pension plans, lowering some interest calculations and spreading out some the liabilities that may have to be paid over time, as well as a couple of perhaps bailouts that might be considered there. And then there were a few things that affect the future. When we get to a section to talk about future tax provisions and what those might happen, we'll cover those as well. But Marty, we talked about the employment taxes and how the Congress keeps using that as a mechanism to put money back into companies' pockets through this payroll tax system. Well, you're right in the middle of the employee retention credit. What's going on there, and what did ARPA do for your clients?
Yeah, it did a lot, and maybe to answer that best, I'll just give a little historical context. The retention credit, employee retention credit, as you said, is a refundable payroll tax credit for companies that have been harmed by COVID to the extent they had some significant decline in their gross receipts, meaning they lost their customer base, or they had some kind of partial shutdown as a result of government orders that were causing them to operate differently and basically limiting the way that they could operate their businesses. Originally, last year in the original CARES Act, this was created as a 50 cents on the dollar employment tax refund, essentially 50 cents, 50% of every dollar you paid to your employees, if you're an eligible employer, came back to you as a refundable payroll tax credit. Also, to the extent you were a smaller company, meaning you were 100 or fewer full-time employees, you really did get that credit on every dollar you paid to your employees. If you were larger, you only got to include wages that you paid for actually retaining people, for essentially paying people who were not providing services while you waited out the pandemic to see how things worked, as opposed to having them take unemployment. The biggest issue for claimants of ERC was that if you took a PPP, you were not allowed to claim the ERC. Later in the year, the rule was changed such that if you claimed PPP, you were then allowed to take a look back and evaluate whether ERC was amenable for your business if you could take advantage of that. Additionally, the ERC was extended into 2021 at a 70 cents on the dollar payroll tax refund for the first $10,000 you paid to any one of your employees, if you're an eligible employer in quarter one and then in quarter two. What ARPA did was extend this into quarter three and four under the same rules that applied for quarters one and two at a 70% refundable payroll tax refund. Also, to the extent you took advantage of the second round of PPP, you could still take this. But then what it also did was extend the statute of limitations such that this could be open to IRS review for the next 5 years instead of 3 years. And it also set up two separate regimes, one for startup companies that might not have the history, the look back history in order to qualify under the original rules for the employee retention credit called the recovery startup business provisions. Also, it provided additional incentives for companies that were severely financially distressed. But for the most part, the big benefit was the extension into quarters three and quarters four of 2021. So a lot of companies are looking at this seriously.
So, Marty, just one or two follow-up questions on this. Where does ERC fit in with this other, these other CARES incentive programs like PPP? How does this integrate or stack up with?
Yeah. So technically speaking, if you could take advantage of PPP and ERC, technically the dollars that you pay to your employees default to being ERC eligible first, and you elect out of that by claiming PPP. Practically speaking, take advantage of as much PPP as is possible for your business, because PPP is 100% coverage as opposed to ERC, which is either 50 cents on the dollar or 70 cents on the dollar per quarter. But then to the extent you have, as a business, the ability to have the PPP cover some non-wage expenses, that will allow additional expenses to be ERC eligible. But if we think about sort of the regime of incentives, I think PPP is probably the most beneficial. This new restaurant revitalization fund is also similarly very beneficial, and you can't double dip on those with ERC. From just the payroll tax benefits that are out there, ERC is the most beneficial, followed second by what's known as the FFCRA.
It was the Family's First Coronavirus Relief Act. That was the very first of the bills that passed. That's for that paid medical leave and paid family leave, isn't it? Yeah.
And then the other one would be the shuttered venue grants as well, which are very beneficial as well. But ERC of the payroll tax refunds is definitely the larger of the two.
And then my other follow-up question, I think we got a little more clarity in recent guidance, but on the wages that we are using for ERC, what are the implications for that in the for your basic tax return deductions, and as well as what other income recognition implications do we have with ERC?
Yeah, what the ERC giveth, the income tax provisions taketh away a little bit, but not too extensively. To the extent a company claims ERC for 2020 or for 2021, that company would similarly have to reduce its deduction for wages for income tax purposes in both of those years respectively by the amount of the credit due to what's known as the operation of Section 280C. There are very similar rules if any of our listeners have ever claimed a research credit. Essentially, you're really taking, in a sense, you're taking that ERC into income. So there is that offset, and it's one of the few, if only, times I can remember two different returns, the payroll tax return and the income tax return, one having an offset against the other. So that is very important for our clients to keep in mind as they're thinking about what the net benefit is of taking advantage of ERC, and just keeping in mind how much cash they need to have on hand for purposes of making their income tax payments. If you're in a loss position for income tax purposes, it's not going to affect you immediately, and not as much.
Right. So I think the bottom line here, there's a lot of planning to be done when you're in a scenario where you got PPP, ERC, R&D, and you're also looking at the timing of the income tax deduction all at one time. So lots of opportunities to take it, to take the ultimate advantage of the system.
Yeah, and you did bring up one good last point there, is that to the extent any of our clients are taking advantage of ERC, those dollars can't also be claimed for the research credit as well.
Correct. Right. Thank you. Good point. All right. So before we move on, I just want to mention that on our website, cbh.com, we have a tremendous amount of material on all this stuff, but in particular with ERC, and Marty's done a recent webinar. So if you want to hear in-depth on, really in-depth deep dive on ERC, that will be available as well. All right. So Kathy, we've talked a lot about ARPA here. So talk to us about the states, because there's all sorts of implications on states coming in and out of ARPA.
Yeah, that's a great point, Brooks. Anytime you have any federal legislation that is changing taxable income or credits or deductions, you really have to look at what the state impact of those changes are. So each state has the ability to decouple from federal changes. Some states, it depends on where you start. If you're starting with AGI, then and they don't decouple from a change, then the state would adopt the change. But each state is different. Also, the states have conformity differences. Some states conform to the federal code, the Internal Revenue Code, on a rolling basis. So if there's a federal change, it automatically gets incorporated to the state. Some are as of a fixed date. So for example, Texas and California have dates that are very old, fixed state conformity to the Internal Revenue Code, and then they adopt specific provisions of how they're going to follow that law. So specifically with ARPA, you have the stimulus payments. So the stimulus payments are exempt from federal tax. They're likely going to be exempt from state tax purposes as well. The states aren't looking to hammer anybody, and most states start with AGI. So if that income's not an AGI, it's not going to be taxable for state purposes. And similar for unemployment as well. I won't say there aren't any states that would try to take some of that income. You have to look at each state on a separate basis, but generally the states aren't going to try to harm individuals for a benefit that's been given at the federal level. I will say also specific to ARPA, with the employee retention credits, that add back the add back of deductions that Marty was talking about that you have to make at the federal level, a lot of states will allow you to deduct those expenses that were limited. So it's you really have to look at the specific state again. It's probably about half and half that you can deduct for states where you had to add it back for the federal on the federal side. So that's really related to ARPA, but the PPP forgiveness has been troubling from the perspective of the states adopting forgiveness as well. Are they going to adopt forgiveness? Are they going to allow expenses? And it's taken a long time, and a lot of the states still haven't provided guidance. So conformity that I mentioned previously is very important to look at conformity to determine whether the PPP forgiveness income is going to be taxable or not in the state. I think most of the states are trying to provide forgiveness for that, either through conformity or through a special provision. But then on the expense side, PPP forgiveness income that was used to cover certain expenses, where the IRS has allowed us now to take the expense deductions. Virginia, North Carolina don't necessarily. So North Carolina, you have to add back those expenses that were covered. And in Virginia, you're only allowed 100,000. And so various states have different rules. Massachusetts, PPP forgiveness income is taxable to individual, but not taxable for business. So you have all these differences with regard to the PPP forgiveness and expenses. One other thing that I wanted to mention with regard to ARPA that has really become the buzz in the state tax world is the funding, the additional funding to the states, up to a $350 billion of relief to state and local governments. And the states are able to use that money for COVID-related expenses and some other infrastructure type expenses. However, it comes with a big catch. And the catch is that the states may not use that money either directly or indirectly to recoup and offset a tax reduction, or to provide a tax reduction or a change that would reduce tax for businesses and individuals. So what does that mean? I mean, what about the states that already had legislation in effect where they were going to have a tax cut come into play? And now with this hook, do they have to, is there a problem in getting this funding? Because the federal government would view that as, oh, this is the way you're reducing your taxes or incentives. New York and California have been especially hit hard by COVID, and so they're needing funding for sure. And what about the surrounding states take all this funding and then provide all these huge incentives for businesses to locate in their state? So the federal government didn't want states to be harmed at all. So they're trying to and not fund tax cuts. They really want it to be used for relief. It'll be interesting to see what happens. We need Treasury regulations to come out to provide more definition around that. We'll say the state of Ohio has already sued. And they want this provision removed, this hook. And more than 20 states have signed on a letter to Treasury Secretary Yellen also saying that a lot more clarification is needed, and this should not be used to limit us from providing tax relief for people in our state. So that's probably the most interesting, I think, out of ARPA for sure.
All righty. Thank you, Kathy. All right. So just kind of a final wrap up observation here is, I think all the listeners need to be prepared for more change. Almost for sure, ARPA is not the last in the rounds of legislation related to CARES, COVID. Regarding the deadline extension, there's continued pressure on the IRS to expand that to different types of entities and to different types of actions. So I think we can expect to see not only more legislation, we can probably expect to see more guidance from the IRS as well. So I think that concludes today's Tax Beat by Cherry Beckert podcast. Thank you, Sarah. Thank you, Marty. Thank you, Kathy. As a reminder, check out our firm's website at cbh.com for more in-depth materials on these topics and others as well, especially the ERC. And let's call it a day. Go forth in peace.